Well, I'm glad to be back. I have to say that was probably the longest stretch in the past 30 years when I have not traded. Normally, when I go on vacations, I try to trade at least a couple hours, at least half the time. But this time I did not, which was good. The charts, I think, are really pretty interesting. The monthly chart has not had a pullback since the beginning of the year. Excuse me, here's the beginning, since November. So right now it's an 11-bar bull micro channel, sign of very strong bulls, but occurring late in a bull trend, and therefore also a sign of climactic unsustainable behavior. The market is around a measured move up from the 2014-2015 trading range, normally resistance, but we're up in a very tight bullish channel, and that makes the downside probably limited. The bears might pull back for a few bars, a few months. It's possible they can get something dramatic like that, or maybe longer, 5 or 6 months, but the odds are bulls will buy the sell-off. When a bull channel is as tight as this is, usually the first reversal down is going to be minor. Weekly chart, we got to within a half a point of the moving average here, but we did not get there. And I think this is now 43 weeks without touching the moving average. I still think that this rally will be a trading range and that we'll test back down to the March or May lows somewhere down here, here or here. But there's no clear top yet, and we have a couple of decent bull weeks. I do think they'll sell a new high, just like they sold above this high, made money. The bears sold above this high, made money. They sold at that high, made money. And if we get above here, they'll sell as well. Daily chart. Sideways for several months and a broad bull channel, but lots of reversals. And you can see we're getting 3 pushes up, 1 pullback, 2 pullback, trying to get a third. Yesterday's a buy signal bar, but it's a doji bar following a doji bar, following another doji bar in the top of this trading range and near the top of this bull channel. And you can see on the 5-minute chart, they sold at around yesterday's high. Not a good looking buy signal bar, not good looking context, and therefore you have to bet that traders will sell above yesterday's high and above this high. If we do get a new high, it'll be 3 pushes up, 1 pullback, 2 pullback, 3, and then you have a wedge top. It'll be enough bars in the pattern for a major reversal, so it'll be a wedge major trend reversal. If it's a lower high, it'll be a major lower high trend reversal. If it's a higher high, then it'll be a higher high major trend reversal. If we turn down right where we are, we have a double top bear flag and a head and shoulder stop, left shoulder, head, right shoulder, with 3 decent bull bars here. Even with the shrinking bodies, the odds are we're going to have to test up to this high. So the downside risk near term is not great. September is a month that has, it's traditionally the weakest month of the year. But the difference between the weakest month of the year and the strongest month of the year is small. On average, the weakest month of the year, September, falls about 1%. On average, the strongest month of the year, I don't know which it is, there's several that are around a 1% gain. And so the difference between the strongest and weakest month of the years is only a couple of points, and that's, basically 1 or 2 big bear days on the chart. And that's enough to account for the difference. And that means that the other 19 or 20 days are the same as all the other days in all the other months. Excuse me, I haven't talked much, or I haven't talked in a microphone much, so it's going to take a little while for my voice to get good. All right, so for the bears, a lower high, we have a buy climax, a strong reversal, two legs sideways to down, one pullback, two. Not a very good looking sell signal bar, bar one. Will the bulls buy the low of one? Some might. They might buy at the moving average, yesterday's close, betting that the best the bears get is a continuation of this trading range. They'll probably make money. I always pay attention to what happens at the high or low of the first bar of the day. If you break below the low and the bears make money, and the bulls make money, that increases the chances that the day will be a trading range day. You can see prominent tail on top, prominent tail below, not a very big bear body, probably not the start of a strong bear trend, probably more a continuation of what we have going on here. So you have bulls buying the one low, they buy more 1 point lower, and it needs to get one tick above that one low for the bulls to make money, which they have not yet. This looks like a spike pullback channel. The bears want to get a test down to this low, the bottom of the channel, and the bulls want a new high. If we do get a new high, then you get one pullback, two pullback, three, and we'll probably get a reversal from a new high. So chances are the upside is not all that great today. Bulls would like leg one, leg two, leg one, pullback, leg two, testing up here, but a lot of two-sided trading, and the rally was not all that strong. So the odds are against a strong rally up to there today. Bulls trying to get an opening reversal up from the moving average and yesterday's close, but just not much momentum. The first two bars not very big, and prominent tails first bar, and about a 40 bar relatively tight range usually does not lead to a strong trend. So yesterday's a buy signal bar, a pullback from a strong reversal up, but it's a doji following another doji, and it's in a several month trading range. So probably sellers not far above yesterday's high, and probably sellers above this high as well, and probably sellers above here as well. Bears have been making money for several months selling every new high. Here, they made a scalp, but they still made money. Here, it took them a couple of weeks to make the money, but they made money. So you have to bet bears will sell yesterday's high. They'll sell this high. They'll sell this high, betting against a strong breakout. They're betting that every breakout will pull back enough for bears to make money. "60-minute chart, big up, big down, big confusion, usually means sideways. And this rally, therefore, is probably a bull leg in what will become a trading range. Bulls getting a buy signal. The bears do not have a particularly good sell signal, bar one. Bulls hoping for a better buy signal, bar two. The limit order bulls made money buying the one low, 1 point lower. That's good for the bulls. If we do get above yesterday's high and reverse, it'll be a failed breakout yesterday's high. It'll be a wedge, 1, 2, 3, and it'll be an expanding triangle, 1, 2, 3. 25% chance if we get a decent buy signal bar here, 25% chance it'll be the low of the day. 75% chance it will not be. The market wants to get above yesterday's high, a bull inside bar after a strong reversal up and a pullback. So they want to see, is it a bull flag, and will it lead to a second leg up from this strong reversal up last week? Probably not. 3 dojis here within a trading range. Probably not going to be a big bull trend day. You can see in the final second from a 2-tick bull body, 1-tick bull body to a doji bar. So it's warning us that today probably will have a lot of trading range price action. 3 small bars. It's a better buy signal bar, but the location is terrible. The top of a several hour trading range, and the energy is bad. While any reversal can be the high or low of the day. This is not a very high probability setup. A lot of traders will wait for second entry buys or second entry sells. Can you sell the 3 high, arguing we're at the top of yesterday's range, and there probably will be sellers around yesterday's high? I personally would not sell with a limit order above 3, although I thought buying below 1 was okay. Location is good for the bears, but I don't like to sell above a bull bar with an opening reversal like that. Limit order bears made money selling 3. Limit order bulls made money buying 1. Today's probably going to be mostly a trading range day, and we're near yesterday's high, so slightly higher probability that the initial swing will be down rather than up, but we're right at the 60-minute moving average support. I think the odds are against a big trend day either way. $15-minute Globex chart. Possible final flag, wedge 1, 2, 3, but we're near the bottom of the range and the top of this other range. So still not much energy. Are we always in long or short yet? Well, the bears would like to get consecutive bear bars. The bulls are hoping still for an opening reversal up from the moving average. If they get a decent bull bar 5, that would be a second entry for their opening reversal up. That would be a higher probability buy, but I think 4 is big enough so that a lot of the bulls will want a relatively strong buy signal bar 5, before they're willing to buy. Also, everyone sees that stop order traders are not doing well here. If they sold below 1, they made a scalp. If they sold below 3, they made a scalp. But you got to be really quick, and you have to go in with the intention of taking a 1-point profit. And a lot of traders early in the day are hoping to get swing trades. So a lot of the traders who sold below 1 and below 3 were swing trading, and therefore, I don't know what they did above 3. That if I sold, had I sold below 1, which I would not have done, would I have gotten out above 3? I probably would not have. I probably would have used a wider stop to wait to see if it breaks above yesterday's high and fails a second time. Of all the stop entry signals, this one has the best potential so far today. A high 2 opening reversal yesterday's close at the moving average. Yesterday's a buy signal bar on the daily chart. But, we're still in a pretty tight range, and this is a dangerous, it's a low probability market for swing trading. So not a very good buy above 5. Let's say 5 has a 1-tick bull body. Can you sell above, betting on the failed high 2 bull flag? I would not. Let's say it has a 1-tick bear body. Can you sell closes, arguing consecutive bear bars, only 1 bull bar in the first 5 bars? I would not do that either. There's just not enough momentum, and we're at support. Yesterday's close, moving average, 60-minute moving average. So best choice right here is wait. Again, no energy, no sense of urgency, no sense that the price is horribly wrong and the market has to race to a new price. Not a good stop entry buy setup. A 1-tick bull body after a fairly big bear bar. So it looks like more of a trading range open. Whenever you have a small day like yesterday, and then today opens near yesterday's high and starts to trade down, you have an increased chance of an inside day. Yesterday's range is not particularly big, and that makes it a little bit less likely that today would be an inside day. But, that's something that market might do. We're testing the bottom of 3 or 4 hour range and the 60-minute moving average. Lack of consecutive trend bars up or down, so not much energy. Are we always in short? I don't know. If I had to guess, I would say yes, but we're at support. And because of the absence of consecutive decent bear bars, and we're at support at the bottom of a range, 60-minute moving average, I did not sell closes. Bears trying to get a breakout here, and then a quick measured move down. We have a double top here. Measured move down takes us to yesterday's low. These small days are always tempting traders to sell big bear bars at the bottom or buy big bull bars at the top. And it's really pretty difficult to do anything, at least right now. Always in short, but at support and not strongly bearish. What are the chances that this could be the low of the day? I would say 30% chance right now, and therefore bears selling here, if they use a stop above the high of the day, above 4, and are willing to scale in, probably have an 80% chance of being able to avoid a loss and maybe make a profit. But not a very high probability trade. Or difficult trade to manage. The reason why traders are willing to sell, despite the trading range, is they think the breakout is strong enough so that the best the bulls will get is a lower high. So they'll sell here, use a wide stop, and then if it quickly goes to a profit target, they'll take profits. If instead it immediately reverses up, they'll sell more higher. And for the bulls, you'll have some scale-in bulls who bought the 78 low and the 60-minute moving average. And right now they're trapped. But will they make money? Just looking at the chart, you have to assume that they will, unless we start to get a series of big bear bars. So scale-in bulls, even if they bought 78 and the 60-minute moving average, right now at least I think will make money, because I think the odds are against a big trend day. I think, like I said, spike, pullback, channel usually converts into a trading range, and the target is the beginning of the channel. So there's a big magnet down here where the market will probably then get a bull leg, and this whole thing becomes a trading range, down and up and down and up, and then try to go down again. Whenever you get a big bar like that and a lot of trading range price action, you're always going to get bulls buying that close. And you can see the bulls who hit buy the market as soon as 7 closed, right? They probably need one more tick. A lot of them probably were filled at the 7 close. Some were filled one tick higher. So theoretically, they need one more tick. And that means there are bulls trying to sell one more tick above that 7 close. That's part of the reason why we're stalling. And the bears know the bulls are doing that, so the bears are trying to sell there as well. So far, bad follow through. Consistent with everything that we see, trading range price action. And so why are we hesitating right here? Buy the closed bulls, 7. The bears do not want them to make money. They want the bulls to be trapped, which would increase the chances that we're going to get another leg down. And what just happened? Bulls who bought that 7 close made money. And that reduces the chances that this is the start of a big bear trend day. Increases the chances that it's simply a bear leg and what will end up as a trading range. Right now, I think we'll probably go lower, down to around yesterday's low. But by allowing the bulls to make money like this, it makes a lot of bears hesitant to sell unless we get a pretty good bounce or a second entry sell. It's just a reminder that today probably is going to be mostly a trading range day. All right, so the bulls have an opening reversal. Well, what do? You can see we tested yesterday's high, reversed down. We're testing yesterday's low. I don't think we're close enough, so I think we're probably going to go at least a little bit lower. While this can be the low of the day, I think it's not a very high probability buy. Remember I said that there would be limit order bulls buying the 78 low and scaling in lower? For the bears, 8 is a pullback from the 7 bear breakout, but who's going to sell below 8? I would not. It's terrible follow through. We might get closer to yesterday's low. Today could be another inside day. Yesterday's a small doji inside day. Today could be an inside day as well. But even with 4 bear bars in the first 7 bars, the follow through is bad and the context is bad. So I would not sell below 8. And the bulls buying above 8, a lot of them are trying to scalp out around the 6 low and the 78 low. So probably sellers around there. If 8 was not a decent bull bar closing on its high, it would be, I think, worth considering for a short. But whenever you have a sell to close, sell off on the open, and then you get a big bear bar with a bull bar, that bull bar greatly lowers the probability of the limit order bears selling that 8 high. That's not the kind of follow through you want on an opening breakout. Too much risk of an opening reversal and early low of the day. Trading range price action. Probabilities gravitate around 50%. Limit order bears, 8 high. Made money, even though it's a good looking bull bar. Again, trading range price action. Low on sell, but I would not sell below 8. Terrible follow through. Plus, buy the closed bulls, 7 made money. You can see the hesitation, right? A lot of bulls bought the 8 low, taking a chance that we'll get a micro double bottom and at least enough of a bounce for a scalp. Bulls trying to get a bull IOI for a possible low of the day. While it can be the low of the day, I still suspect that more likely we'll get at least a small second leg down. We've already had a small second leg down at 7 and then second leg 9. However, just like I said, I would not sell above 8. I would not sell above 10 if it's a bull bar. It would be a second entry buy. My problem with it is there's still pretty good room to yesterday's low, and we got to within 1 tick of yesterday's high. We may get closer to yesterday's low. For the bears, it's a micro double top. Up on 8, down on 9, up on 10, and then they hope down on 11. So a low too short below 10. But, I think bears want to sell higher and not below 10. And bulls, second entry buy, failed breakout, 60-minute moving average. But pretty tight bear channel. While it could be the low of the day, I would, instead of buying with the stop, today's basically a limit order day so far. Instead of buying with the stop above 10, I would wait to see if we start to get 3 or 4 bull bars and then buy higher or buy pullbacks. Bulls want a good buy signal bar. but so far, lack of strong follow-through buying and selling. So chances are there's going to be something wrong with this buy setup, and chances are we're going to go sideways here. So chances are buyers below 10, sellers above 10. Obviously, if we get a strong reversal up, it'll become always in long, but more likely the best the bulls get is a test around the 78 low, where the limit order bulls will sell. They bought the 78 low, disappointed by this, they bought more, either above 8 or they'll buy above 10, and they'll try to get out around that 78 low. Low too short, but tight trading range, and a doji sell signal bar. I think we're always in short, but it's better to be selling with limit orders and buying with limit orders. I think the odds are we're going to go a little bit lower, but I think the bears who are selling, we're looking to sell the 10 high, the 9 high, the 60-minute moving average, or the 78 low, and they're probably scalping for 1 point. Not a great stop entry sell. Probably buyers below 9, buyers below yesterday's low, possibly buyers at the 11 low, but fairly high up in a bear flag. Where do the bulls buy again? Well, they'll probably buy the 9 low and yesterday's low. And for the bears, they're probably scalping. Some bulls might buy the 11 low, but too much room to the 9 low. So I typically do not do that. So it's better to buy 1 or 2 point or 1 point below the 9 low and buy, the 11 low. Some bulls will buy the 11 low, but too high up in a bear flag. So if you have a better choice, if you're going to be buying the 11 low, instead just buy 1 point lower. Bulls still hoping for the low of the day. That's the close of the first hour. Big up, big down, big up, probably sideways here. We have a reversal, not all that strong, a pullback rally testing that low, probably a trading range here. Possibly a stop entry buy for a low of the day. If it's a really good looking bull bar, 3-tick bull body, 4-tick bull body closing at its high, bulls will be more inclined to buy it. Otherwise, I think a lot of the bulls will wait to see if we start to reverse 7, if we start to reverse up strongly. You still have limit order bulls 78. They got trapped here, they got trapped here, but it looks like they're still buying, trying to get back above that 78 low. A lot of reversal days where the market sells off and then goes the other way, sells off, goes the other way. Because of limit order traders making money buying and selling today, a lot of traders are hesitant to enter with stops. Buying above 8, buying above 10, buying above 13, I think has a higher probability. A failed low 2, test of yesterday's low. Outside up, right? So again, creating a situation where the risk is greater. You're buying at the top of a bear flag, a tight trading range, and the probability is less buying at the top of a tight trading range. So while it's possible it's the low of the day, a lot of bulls will not buy that. They'll wait to see if we start to reverse up strongly and then buy after they see the reversal. this is just too high up for a lot of bulls to be buying. Limit order bears selling 11 high. Limit order bulls who bought the 78 low are trying to get out up here. So you have bulls selling. Big sell climax bar 7 and decent reversal. Right now, a lot depends on what 14 looks like. If it's a decent bull bar, then we'll probably get up to the 7 high. For the bears, can they sell below 14? A triple top, a bear flag, a low 3, low 1, low 2, low 3. We're getting a good bull bar here, good bull bar there. Terrible follow through for the bears. Limit order trading. I think most bears will not want to sell below 14, just like a lot of bulls are hesitant to buy above 13. At a minimum, the bulls want a bull body on 14. The minimum follow through after the reversal on 13. The bears, I think, want a really good sell signal bar, and they'll probably not get it. So probably buyers below 14. If 14 is a 3 or a 4 tick bear bar closing on its low, then bears might sell looking for a test down to yesterday's low. But anything less than that, then probably buyers below 14. Bulls are hoping this is just a sell vacuum test of yesterday's low and that we're going to channel up for the next 2 or 3 hours. How many bull bars do we need for always in long? Usually, if the bars are not particularly big, you need about 3. Back up to the 78 low, where some limit order bulls are trying to sell. They bought the 78 low, they bought more 1 or 2 or 3 points lower, or they bought more above a bull bar like 8, and they're trying to avoid a loss, trying to make at least a small profit on their second entry. So you have some bulls selling here. You have other bulls looking at this as a reversal day, and they're looking to buy below bars, below 14, below 15, betting that we've seen the low of the day. They're hoping for this sell off and then rally for several hours, sell off and then rally for several hours. Bears are hoping this is still a bear flag and then we get another leg down to yesterday's low. It's interesting how we have to wait until the final seconds of every bar, right? That's consistent with trading range price action, that you just feel like you want more, you want more. You want the information to come faster. And when it does not come very quick, that is consistent with a market that's not going to go very far one way or the other. So it's trading range behavior. Bulls trying to get a gap. Bears get a gap down below 6. Bulls trying to get a gap back up. First target, the top of the sell climax, 7 high, maybe 6 high. Probably always in long. The bulls, I think, would like one more good bar. Good bar for the bulls. Okay, so always in long, but it's possible that it's the opposite of 7, a bull trap. I think probably strongly enough up. So that's why traders are buying this. They're buying thinking that either we're going straight up or we're going up. And if we come down, there'll be buyers below. Can you sell? Arguing possible double top 6 high. I would not. This is enough of a surprise so that the odds are we're going higher. What about the bears who do sell here? Well, because of the trading range day, they probably will make money. Just like I said over here that the bulls buying below 78 probably would make money. The bears selling at the 6 high probably will make money. But I think it'll be easier to make money buying pullbacks than selling the first leg up. Can you sell that 16 close like buying the 7 close? I think the context is different. The market at 7 was deciding whether the day would be a trend day or a reversal day. And the market right now is in a reversal day. So the market has already decided that the first rally or the first leg is going to be up. You know, we obviously had a 1 hour sell off, but the market has decided that we're always in long. And therefore, I would not sell the 6 high. You know, can you buy the close? Well, obviously, stop is all the way down here. I think we're always in long. I think the downside risk is small, but you have to be able to put a stop down here, and you probably have to be willing to buy lower. What kind of follow through 17? Chances are it'll be disappointing for the bulls because of the left. You know, multiple reversals. You know, strong bear bars, bad follow through. Good bull bars, bad follow through. Good for the bulls, bad follow through. Good for the bears, big reversal up. So the entire screen is filled with disappointment, and therefore 17 will probably disappoint the bulls, but probably buyers below 17. Buyers or sellers below? Probably buyers below. Can you sell above? As I said, I think it's easier to make money buying. I think there probably will be sellers somewhere above, but I'd rather be looking to buy. My clock is not working right today. I'm going to turn off the screen for a second and try to fix it. Where do the bulls buy? Obviously, they'll start buying at the 17 low. They'll buy at the moving average, 60-minute moving average, 50% pullback. The bottom of the 16 and 15 buy climaxes, just like there were sellers up here. And to sell below this, is it a second leg trap? Leg 1, pullback, leg 2. I think the odds are there'll be buyers below. So I think it's a low probability sell. Limit order bears selling. 17 high made money. So that's a reminder that it's not a strong bull trend day. Let's say it's a bull IOI. We're always in long, but I think bulls would rather be buying below bars and buying at support, like the moving average. So traders buying for any reason, buying 17 low, 16 close, 19 high. I still think they need a wide stop. And for the bears, they made money selling above 17. Will they sell above 19? You know, a lot of them don't want to do that because 19 is a high to buy a bull or possible bull IOI if it has a bull bar. So lower probability sell. What are the chances that today's one of those days that just rallies sharply and sells off sharply repeatedly? You know, those days are not all that common. This kind of a day. Usually you get a second entry sell, you know, for the bulls, a high 2, but you can see 2 problems with it. Well, several. It's a trading range near the top. 2, 19 has a tail on top and a big bear bar, 18. And then 3, limit order bulls at the 17 low or 1 tick below 17 will probably look to scalp out. So you'll have bulls selling not far above 19. Probably limit order market here, but I think easier to make money being long than selling here. I'm not buying here. I bought 1 tick below 17. The reason for that, instead of buying exactly the 17 low, is I thought we'd pull back more than 1 tick. I thought you'd have limit buy the closed bulls 16, would buy more 1 point lower, but a lot of times it'll fall exactly 4 ticks and not fill them. So I wanted to buy 1 tick above where they would be trying to buy. And I just get out and I'm back to flat. And I'm looking to buy again. You know, maybe around the moving average, maybe around the 18 low. For the bears, micro double top, but I would not sell with stops. I think it's better to be looking to buy a pullback around both moving averages. Limit order bears made money above 17. They made money above 19. Limit order bulls probably will be buying somewhere around 19 low, the moving averages. And then we have a buy climax 16 and 15. So they'll try to buy there as well. And then we have a test of the 78 low again. So probably buyers there too. We broke below it the last time, but we broke strongly back above it. So more likely buyers somewhere around the 78 low, below 19. Bears hoping for an endless pullback and then a reversal down, but I think more likely always in long, and bulls buying below bars. Unlikely to be a strong trend day either way. Getting near the top of the range, so probably sellers somewhere above, but I'd rather be long or flat looking to buy, and I'd rather be buying with limit orders below bars than with stops above. Reminder, trading range day. I did not buy the 19 low. I wanted to wait to see if we went sideways, and I did not sell the 19 high. So right now I'm trapped out, and this is the kind of day that I was talking about. You sometimes see where it just makes these very abrupt reversals repeatedly all day. You get that maybe once every couple of months or so, so it's fairly unusual to get this many. You can call it a triangle type range. Still more likely buyers 16 low, 15 low, and 60-minute moving average and 78 low. So I'm not selling yet. Was it reasonable for the bulls to buy 19 low? Probably, and then a lot of them theoretically are disappointed by 20, and they got out break even 21. Can you buy the 21 low? Same logic. It's probably okay to buy that as well. And then scale and bulls will look to buy above a bull bar somewhere down here, especially a second entry. And for the bears, I'm not selling this low. This is a trading range day so far, and we're below the midpoint. So if anything, bears will be looking to buy here, buy back shorts. Some bears might have sold 12 high and then sold more below 18, and they're trying to get back out at the 12 high. So it should be bears buying here and bulls buying here as well. Bulls buying because they know the bears are buying, and because they think this is simply a pullback from this reversal. Big enough breakout 22, a lot of the bulls will wait to see if we get a second entry buy. So when you get a sharp sell-off from a strong rally, a lot of bulls will wait for a second or a third entry buy. Here, micro double bottom, and then they bought. Still always in long, so I think it's okay to be buying here. But 22 is a surprise bar, and usually it's better to take a second entry buy. Buyers or sellers down here? Probably buyers, right? It's probably a limit order market. This is bar 24, the close of the second hour. And you can see originally, or a few minutes ago, it was a big bull bar reversing the first hour. And now it's simply a doji and a continuation of this 10-bar trading range. 22 likely to have a second leg down, and 24 is a second leg down. But as for selling down here, pretty much big up, big down, big up, big down, big up, big down. Probably this kind of a day. So to me, this is the buy zone. I would not sell down here. We had a pretty good sell-off down here, and a lot of times if the market reverses straight up like this, it has to come down and test this. For the bears, lower high major trend reversal, bull trend bear breakout lower high, but the reversal up is so strong, sideways is more likely than down. Also a head and shoulders top, but I think sideways more likely, so probably buyers down here. Bulls have bought 1 point below 23, made money. So that should not happen if this is going to be a strong sell-off. That's the close of the hour. Bad follow-through for that big bear reversal, but that's expected, I think. We have big up, big down, big up again, and we're starting to go sideways. So probably more sideways. Even if we go a little bit lower, probably still sideways. So more likely buyers 23 low, 1 point lower. If you're a bear, do you want to be selling here? What's your premise? Lower high major trend reversal? Maybe, but bad follow through 23, big tail 24, and bulls made money buying below 23. So so far not a very good looking sell. When you get these sharp reversals, as I said, a lot of traders wait for second entry buy, second entry buy, second entry sell, second entry sell. For the bears, they have a reversal down and an inside bar, so it's a low one short. But we've had bad follow through up and down all day. This is low in a day that looks like a trading range day, and we're at a price where the bulls bought several times earlier today. So low probability sell below 24. If it was a bull body, I think there probably will be buyers below 25, 24. If 25 had a bull body, bulls would be more eager to buy with a limit order at the 25 low. And for the bears, a lower high major trend reversal. We have a bull trend. It's a bull trend inside of a bigger bear trend, but it's still a bull trend. Bear breakout, lower high. Most likely, we're going to continue mostly sideways. Here, is it high enough up to sell? For the bears, double top 23. It's probably okay to sell, but I was looking to buy and obviously did not. Now I wanted to buy with a limit order below 25 or 24 and could not. Are we always in long or short? I think we're still always in long. I think there'll be buyers below 25, 26, 24. And if we go to a new low of the day, probably buyers below as well. But tight enough bear channel, still room to the low of the day. I think, I'm not willing to buy up here. I think that we'll probably get a test down, but it's one of these days where once it starts going up, it goes up far. Once it starts going down, it goes down far. I'm just not convinced yet that it's finished going down. I think it probably has to go sideways more. Limit order bears sell 25 high and or 1 point higher. They'll probably make money. And limit order bulls, there's a low 2, a double top bear flag 23, 27. I would not buy below 27. We're too far up, too much room to the low of the day and yesterday's low, so I'd rather buy lower. Tight trading range, limit order market, and the range is fairly small. Are we still always in long? I think you can make a case both ways. The bulls did not get above the top of the sell-off. The bears did not get below the bottom of the rally. To me, we're probably still always in long. I think the downside is limited, even though it's a lower high major trend reversal. Only 40% of them lead to major reversals. Most lead to either a trading range or a resumption of the bull trend. I am currently flat, and we're in the buy zone, so I'm looking to buy. When the range is very tight like this, it becomes difficult to make money even with limit orders. For the bears, they're hoping for a nested head and shoulders top, left shoulder ahead, right shoulder, and then a smaller head and shoulders top within the right shoulder, left shoulder, head, right shoulder. Again, only 40% chance the bears are going to get a swing down, 60% chance the day will remain a trading range day. 29 is a second entry buy, but a bear body and consecutive bear body, so not a very good second entry buy. What happens if we get a big bear bar or pair of bear bars? Well, we're still in an area where the bulls have been buying. They rallied here a couple times. So odds are The downside is limited. I don't know that we go up, but I think we're probably going to enter a triangle. Most head and shoulders patterns are triangles. You know, you got left shoulder, head, right shoulder, 3 pushes down after the left shoulder, after the head, after the right shoulder. So it's also a triangle. Breakout mode with all triangles. 50% chance the first breakout, down or up, fails and reverses. 50% chance once there is a successful breakout, it'll be up. 50% chance it'll be down. Because it's a triangle, in general, better to look to buy low, we're low, and sell high. So this is, to me, low in the pattern. So this is a buy zone. But, you know, pretty quiet day, so not very good stop entry trading. For the bulls, they view this rally as a bull breakout and this sell-off as a bull flag. This is a breakout of the bull flag. Channel very tight. A lot of bulls want a second entry buy, and this is an attempt at a second entry buy, 32. But unless it's a really good looking bull bar, a lot of traders will not buy using a stop above 32. So right now, I think a lot of traders are just waiting. I still think it's more likely always in long. So I'd rather only be buying here. So second entry buy, but you know, I think it's going to be a little bit tricky to manage. You know, the probability, you know, your risk is 7 ticks right now. Is your goal 4 ticks? You know, I don't know. You know, when I see a day like this, I'm usually trading it with limit orders. Limit order bulls. Still always in long, so I'm slightly more bullish than bearish, but the odds are this is not going to go very far up or down. Getting near the end of the hour. Last hour was a doji inside bar. So far this hour is it's another inside bar. Limit order bulls 33 low. They got their 5 ticks and they sold. And that's part of the reason why we're pulling back a little right here. It's still on that buy from 32. And for the bears, they have a small triangle. 3 reversals down, 28, 30, no, 4, and then 33, 35. Slightly more bullish than bearish, but I'm pretty neutral, and I'm currently flat. The range is too tight. The math is too bad for me to make money right here. New low of the day, so you got to bet there are buyers at 9 low, despite the lower high major trend reversal. It's also a failed breakout below a double bottom and a failed breakout below a head and shoulders top. Left shoulder ahead, right shoulder, trying to break below the sell-off from the head. So what about buying with a stop? Well, limit order bulls, 9 low, probably will make money. Stop order bulls after the 3 bear bars. It's strong enough, so I think a lot of them will wait for a second entry buy. And for the bears, I think they're mostly scalping. In other words, they'll buy back their shorts at the 9 low and then look to sell again on a bounce. I'd rather be buying with limit orders. Below bars, below 24, 1 point lower, below 9, below 13, 1 point lower. And to sell, I'd rather be selling closer to the average price, the moving average, and not the 38 high. Can this still be a successful major trend reversal. It's possible, but not likely. This is the breakout, 37. We had a breakout here, bad follow through, breakout, bad follow through, and we're getting a breakout again, bad follow through. That reduces the chances that the bears will get a measured move down based upon the height of the range. That makes this unlikely today. Nobody wants to do anything. Nobody wants to sell the 40 low. Looks like not a lot of buyers here, but I think we're in the buy zone. You can see some selling at the moving average, scalpers. A limit order, place a limit order to sell a tick or two below the moving average, and then they buy back on 41. It's a small spike and channel down, spike, pullback, channel. Target, the top of the channel, 27 high, but I think most bulls will scalp out. Buy with limit orders, below 9, below 24, below 40, and scalp. Bears, they sold at the moving average. They might sell the 40 high as well for a scalp. They'll have a low 2 with bar 42, but I think most of them will not sell below 42 because it's too low in the channel. Plus the stop would be above 42 and the risk would be too big for a scalp. Double top in a bear channel, 33. But I think bears would rather be selling with limit orders above bars above 40, 1 point higher, than with stops below bars. I still think we're always in long, even though we broke to a new low. However, I also think that today's going to remain a pretty quiet day, that we're probably not going to go very far up or down. And traders are mostly scalping for 1 point or 2 points. Buy low, sell high. We're getting a little high. So bears would like to sell. And bulls are happy buying, but they want to buy like a second entry buy. Or if we go sideways, maybe get a high 2 at the moving average. Bulls trying to get up near the 16 close. Too many bulls trying to buy the 43 low. And therefore, we're going up instead of pulling back. The bears, they will sell here. They'll sell above highs, 43, 28, betting that if they use a wide stop, maybe above 18, maybe above the high of the day, the odds are very good that they'll make money. What do you do here if you're flat? I think we're always in long. I think it's easier to make money buying. But if you buy, your stop is below 37. For the bears, I think they will make money selling up here, but I think we're going higher, so it's probably a little early to sell. They have a little gap here, and that would be a target around the 20 low, which was a reasonable area for the bulls to buy. And you have scaling bulls who bought the 20 low, 21 low. They bought more above a bull bar, like 33 or 38, and they correctly expect the market to get back there so they can get out break even on their first entry, and then with a profit on their lower entry. Double top 28, a wedge 40, 43, but a very tight channel. A lot of the bears are either selling with limit orders, which I think is the better way to sell, or they'll wait for maybe a micro double top here or a strong bear breakout. The bulls, they want to buy below bars, but they don't want to buy too high up. They'd rather buy where they bought earlier today, here or here, so which means somewhere a little bit lower. For the bulls, they're hoping for a break above the double top, 28, 45. They close that gap below 40, so they get rid of that. And they're trying to break above this double top to get back up to the high of the day. A lot of the bulls are hesitant to buy with stops above bars. The bears are happy to sell, but they're doing it with limit orders. You can see they sold the 33 high and then they scalped out. Whenever there's a wedge like this, 40, 43, and 46 or 45, and you get a breakout, 51, 50-50 chance, you get a measured move up, 50-50 chance, the breakout will fail and you'll get a reversal down. I'd look at this as a trading range for about 30 bars, and therefore I think traders will probably be selling above highs, above 45, above 28 if we get there. I still think we're going to get up to the 20 low, 21 low. Those are reasonable locations for the scale end bulls to buy, and they'll keep buying until we get back there, and then they'll try to get out break even on their first entry and with a profit on their lower entry. And because I think the odds are we're going at least a little higher, the probability is against the bears, right? If you're selling with limit orders at highs, scaling in higher. I think we've probably seen the low of the day. We may also have seen the high of the day. Coming into the day, I said today could be an inside day. Yesterday was a doji day after a big doji day. And so far today is an inside day. Did not get above yesterday's high, did not get below yesterday's low, and we may end up closing somewhere in the middle, maybe around yesterday's close. The midpoint of the day's range right now is right where we are. Small spike in channel. Again, limit order traders, I'd rather be selling with limit orders than stops. Might get a couple legs down, target bottom of the channel, so spike, pullback, and then wedge, 1, 2, 3. Probably a couple legs sideways to down to the 47 low. Buyers to sellers. I think probably sellers above for a small second leg sideways to down after the wedge. But I think we're still always in long. Probably buyers below bars, below 62. Probably buyers below 54, 47. Now I said 2 legs down, wedge, 1, 2, 3, possibly 1 pullback, 2. Because we have this pause and a possible second leg, it's a lower probability sell, 64. The bears are hoping for a wedge lower high. I still think it's always in long. Very quiet, very small bars. Everyone is trading with limit orders. You can see they bought the 62 low, and a lot of bulls are trying to sell 4 ticks higher, which is the 65 high. The bears want to sell above prior highs, like above 59, and then up at resistance, the 20 low magnet, the 21 low magnet. The market's deciding whether this is already 2 legs down, 1 pullback 2, or is this 1 pullback 2 down to the bottom of the channel. Whenever you get a spike in channel, even a small one like this, the market often hesitates halfway down, and traders wonder if the correction has ended or if it has to go further down. Usually, better than 50% of the time, it has to go further down. There's a test of the wedge top. A lot of times when you have a wedge like 45, 51, and 59 or 58, the market starts to reverse down 64 and then forms a perfect double top with the wedge high. But when the pattern is this small and the range is this tight, it usually is not a very good strategy to sell with stops below 67, looking for a break below the 64 neckline and a measured move down. If you're selling, it's better to be selling with limit orders above 64. Above 59 did not get there, and better to be buying with limit orders below 64, below 47. Bears getting a breakout, trying to get down to the low of the day. I think too late in the day to sell with limit orders. And stop order bears who did take this short, the I think for the most part would scalp out, so they would be buying back their shorts here. 2 legs down after the wedge, a test of the 47 low, but only a doji buy signal bar and 3 consecutive bear bars. I would wait for a second entry buy. Limit order bulls who bought the 64 low tried to buy more 1 point lower, and they were not filled. The ones who did buy the 64 low probably get out at break even on 73. Right here, I think there's nothing to do. We're in the buy zone, but we did not. I think 72 is not a good enough buy setup, and it's really late in the day for limit order trading. So traders are waiting to see if we get a trend, a buy the close or sell the close trend, not likely, or if we'll stay mostly sideways. And if we go mostly sideways for another few bars, traders might try one limit order scalp, buying at below bars, selling above before the end of the day. We've been in a 3-point range now for 25 bars. Most traders should just wait. Outside, you can see bulls bought with limit orders. I think they're less willing to buy with stops above 73. Boy, there were a lot of little scalps, limit order scalps all day. At the end of the day, I look back and I say, boy, there was a lot, and I ended up never taking as many as I would like to have taken in hindsight. But today was really a good scalping day with limit orders. Daily chart today is an II. It's inside yesterday. Yesterday was an inside bar. And we had 3 dojis in a row. If you want, you can call today a doji as well. And the market has been in a tight range now for certainly through here, so certainly a couple of months. And even though we're in a bull channel from here, I still think this is a trading range and it's breakout mode. For the bears, it's a head and shoulders top, left shoulder head, right shoulder. Looks like we might get one more push up, 1, 2, 3. In any case, it still looks like a head and shoulders top or a lower high, major trend reversal and double top bear flag. And if we do break below the neckline, measure move down takes us to where I think we're going to end up the March, April, May lows. So about 170 points down, 150 points, 200 points down, somewhere around here. And, nobody knows when it's going to happen, but because the monthly chart and weekly chart are both so overbought, the odds are we're probably not going to go very much higher before we get the correction. If we go above the all-time high, then we'll have a wedge. 1, 2, 3. Monthly chart, this is an 11 bar bull micro channel. It looks like instead of a parabolic wedge, 1, 2, 3, these 4 bull bars were strong enough to start the count over again. So now it's 1, 2, and then maybe a little bit higher for 3. It's possible that we just turn down without going a little bit higher, but we might go a little bit higher. Weekly chart, 43 weeks without touching the moving average. We got to within a half a point a couple of weeks ago, but we still have not touched. That is good because it relieves some of the exhaustion on the part of the bulls, and they might get a little bit higher out of it, but I think the odds are against the market going much higher. And with this being as overbought as it is, we're probably going to be sideways for 6 months to a year. We're simply looking for the top of the range. It's similar to 2003. Got close to the moving average, around 20 bars, 25 bars. And then we went sideways for about 10 or 11 months in a range, maybe a 10% range, but sideways for a year. And I think this is what the next year is going to look like. The market reversed up fairly sharply and then sideways. And the bears want head and shoulder stop, left shoulder, head, right shoulder, and measured move down. But even if they get it, I still think probably buyers below, and I think we're probably going at least a little higher. And the bulls obviously want to break above this high, 60-minute chart. They want to break above this high. But even if we do go to a new all-time high, I still think there'll be sellers above, and we'll get a big expanding triangle. 1, 2, and then 3. So I think the upside is probably limited. And I think even though we're in a bull trend on the 60-minute chart, well, the daily chart, weekly chart, and monthly chart, I still think the buy climaxes on the weekly and monthly chart are so extreme that the E-mini is going to have a hard time going much higher without correcting down probably to the March or May lows. Yesterday, a channel after a spike up here, and then we had a big sell-off on the open and then a big rally. So, we got big up, big down, big up, probably a trading range day. For the bears, head and shoulder stop, left shoulder, head, right shoulder, lower high major trend reversal. But this rally was so strong that it made a major trend reversal unlikely, and we're probably going to go sideways for the rest of the day. Right on the open, we got good information. Bar 1 small, so probably not a lot of interest in making the market go up or down. And the bulls who bought below 1 made money. The bears who sold above 2 and 3 made money. And the bulls who bought below 2 and 3, if they used a wide stop and scaled in above 10 or 13, made money. And then we started getting second entry buys and sells. Here, second entry or third entry, and second entry, third. I think really difficult to trade with limit orders. With stop orders. I don't know that I did a stop order today. I was doing all limit orders. The bears got an outside down on 4, but we're still in a 30-bar trading range, and then bad follow through 5. The bulls had a high 2 opening reversal, a sell-off down to the moving average yesterday's close, and a high 2, but a 1-tick bull body, and it never triggered. And then 7, I said at the time, very big bear bar, but the bad follow through on 2 and 5 made me think bulls might buy the 7 close, betting on at least a scalp. And then you can see after 7, a big bear bar closing on its low, I think it's natural to assume the market's going down, but if you look to the left and you see all the trading range price action, and then even today, bad follow through, bad sell signal bars, bad buy signal bars, bulls and bears making money with limit orders, you have to assume 7 is going to have bad follow through, and it did, bar 8. Strong enough down, 7, so probably sellers above 8. But when 8 closes on its high like that and it has a body that's at least 3 ticks tall, I virtually never sell at the high of 8. Instead, I look to buy below bars, like below 11, below 10, below 9, below 8, and look for a scalp. And then we have a double bottom, 9 and 13, and that made me think that today might be some variation of this, where we got a strong move up and down repeatedly and reversing. And today is similar to this, a triangle trading range day. We got strong down, strong up, strong down, and then the momentum started getting less, and we just ended up sideways for the remainder of the day. Here, another micro double top, strong breakout here, maybe a little bit more down. Could not get below yesterday's low, reversed up after 3 bear bars. Not a strong reversal up, but strong enough up to make it unlikely that we're going to go very far down. And we just oscillated around the 60-minute moving average all day within yesterday's range. For stop entries today, you can argue selling below 3 or 4 is okay. We're reversing down from yesterday's high. We should try to test yesterday's low. I think I said at the time 9 and 13. My concern was we did not get close enough to yesterday's low, and therefore we're probably going lower, even though it looked like we were going to go up first. Limit order bulls have bought below 2, below 4, below 3. Probably are buying above bull bars 8 and 13, and then looking to get out around their first entry, which is why the market sold off here. The bulls bought aggressively to get it back up there, and then they get out break even on their first entry and with a profit on their lower entry. And the bears knew the bulls would do that, so the bulls were selling exactly where the bulls were selling as well. The bulls were selling to exit, the bears were selling, looking for a leg down. Stop entries today, really not good sells here. Buying above 8, I think you can do it, but you have to use a wide stop. I'd rather buy above 10 or 13, even better. And then selling up here, micro double top, I would not sell below 18 or 19, but if you want to be aggressive, you could sell below 20, although I would not. I'm selling with limit orders above bars, and I'm buying with limit orders below. I bought below 17, but I did not want to buy the second reversal down, because if this is going to be one of these days, the second reversals tend to lead to a swing. Second reversal up leads to a swing up. So I don't want to be buying a second reversal down. I don't want to be selling a second or third reversal up. One short that I did not take with the stop, bar 35, I just, the few seconds in there when it set up and the bar closed, I was not looking at that chart. I was looking at another chart. So I missed it. Had I been looking, I might have sold it looking for a test down to yesterday's low. And then buying above 38, 3 consecutive bear bars, probably better to wait to see what we get. And I'd rather buy with a limit order on below 40. And then it's just really quiet in here. Not really good stop entry trading. If you bought above 48, you did not make money until 10 bars later. And if you bought above 54, you did not make money at all. You can say a wedge here, 46, terrible sell signal bar, tight channel, bad stop. We have a bear II here, failed breakout above the wedge, and it's a bigger wedge, but I personally would not sell with the stop. I was selling with limit orders. And then 64, maybe 2 legs down, 61, 64. I thought we probably were going further down, not enough bars to correct this, plus room to the 47 low. Then we had another bear II 71, but I thought I'd rather be buying with limit orders below bars, 64, 54, 47, and then if we got down here, buy here as well. Another big bear breakout 71, like bar 7 and bar 36, but it's a trading range day, so we're probably not going all that much further down. And then selling below 73, you cannot. And then buying with the stop above 74, I did not. Buying below 76 for a scalp, I think that's okay. Buy the close, sell the close. It's a trading range day and a limit order day, so I'm always thinking about opposite. So if I see a big bear breakout 7, I'm looking to buy either on the close of 7 or below bars, below 8, below 11, something like that. And then I see a big pair of bull bars, 15, 16, but failing to get above the high of the day. Yes, I'm going to be buying below 17, but I'm going to be scalping for 1 point because we could get a deep pullback, which we did. And again, it's all opposite. So you see big bear bars, 7 near the low, 36, 24, 22, 71, they're buys. And you see big bull bars in the top half, well, they're sells, although I was buying up here. I bought over here. But big bull bars near the top of anything, they're sells all day long. Where do we go from here? I still think we're going higher. Let me go to the daily chart. I think it looks like the momentum up here and here is good enough so that we'll probably get an attempt at a wedge, 1, 2, 3, and we might get to a new high. I don't know. After 3 good bull bars here, this is a low probability short. The bears probably will need a microdouble top, which means we probably have to get up to this general area the next day or two. Big picture, I think we're going lower, but we do not yet have a credible top. And when you have a chart that looks like this, a lot of trading range price action, and every reversal up and down only goes for a few bars, a lot of the traders scalp. So they'll trade the reversals, but they'll scalp. On the daily chart, they'll hold for a day or two. And the result is, by the time everyone decides that we've broken out up or down, the market has already gone at least halfway to its destination. So by the time, let's say we get a strong bull breakout, by the time we get the bull breakout, there's probably not much left to the upside. If we get a strong bear breakout, probably not much left to the downside. I still think it's more likely that we're coming down here and the market is deciding whether it has seen the top or whether we go up higher and see the top. And as I said, traders are making money selling above every prior high. And that's what they'll do. If we get above this high or that high, the all-time high, bears will probably sell. And you can see bulls are also buying below lows. They bought below here, and they even bought below here despite that bear bar. They bought below here. I think we're waiting for, I think it's 3 central banks. I'm not even sure which ones they are. In the United States. I don't know if England is, if Germany is another one. But anyway, in September, 3 major countries are making interest rate decisions, and the market, I think, is going sideways, waiting for the results of those decisions. And until then, most of the days are going to have mostly trading range price action. Okay, when a trade goes against you, how do you decide whether to take a loss or scale in further and try to break even or make a profit? Well, first of all, it depends on the time of the day. If it's the last half hour, I'm going to take a loss. And second of all, if there is a strong move against me, I decide if I think the market is converting from a trading range day into a trend day. And a lot of times, let's say I bought the 3 low, which I did not. But had I bought the 3 low, where would I get out? I probably would get out on the 4 close. I think it's a trading range day. I'm going to get out early. And so on a day like this, let's say I buy the 3 low, I'm probably not going to hold it all the way down to the 8 low and buy more above 8 and then or more above 13. For me, I'm going to get out early. However, let's say I buy the 8 low. Am I going to get out below 8? I probably would not. We're probably in a trading range, and it's probably not much downside at that point. So if I buy that 8 high, I'm not going to get out below 8. But if 9 closed on its low and then 10 closed on its low, I would get out, and I might even go short, because then my belief that the day is a trading range day is wrong. As long as the market is having strong breakouts but bad follow through, then I believe it's still showing trading range price action, and therefore I'm willing to trade it like a trading range day. So as long as my premise is correct, I don't worry too much about holding on to positions. However, trading range in general, I don't want to be buying high. I don't want to be selling low. Therefore, I'm not selling down here, and therefore the market cannot go much up against me because, I'm not going to be selling low. If I'm selling, I'm only going to be selling high. And if I'm buying, I'm not buying up here, so the market cannot go against me. If I'm buying and I'm buying up here, I'm just going to scalp. And if I get 3 bear bars, I'm going to exit on the 3rd bear close. If I get a second entry short and I did not yet make my profit, I will get out. So your question, in a way, implies that you're buying high and you're holding through a big sell-off. And if you think the day is a trading range day, and the market's near the high of the possible high of the day, like up here, I'm not buying. So I'm not going to be buying up here and holding through this, right? I'm not buying up here. If I'm buying with limit orders and scalping. And if it starts to go against me, I'm going to get out quickly. So, the one thing where we disagree on, and the question is, you're speaking about generalities. If you're buying, for example, and the market goes against you, do you scale in or do you get out? It depends. If I think it's a strong bull trend and I'm buying high, I don't worry as much about holding long and scaling in lower. However, if I think today is probably a trading range day, I'm not going to be buying high in the first place. And therefore, the issue of holding through a sell-off and scaling in lower is really not important to me because I'm not going to be buying high. I'm only looking to sell high. By the way, I had a really nice time with Laura in Europe. We had a really, really nice time, and it's good to be back. As I said on the open, I've been trading now for over 30 years. I don't ever remember going this many days without taking a trade. I tend to get really restless, really bored pretty quickly, even on great vacations. And I flip on the computer and I try to take at least a couple trades in a couple hours, and it makes me feel happy. This is the first I've decided to experiment and see how I would feel not taking any trades. I check the market every day, but I did not take a single trade in the entire time I was gone. And whatever that is, I don't know how many trading days that is, 6, maybe 5, 6 trading days. I don't remember in 30 years ever going that many trading days without taking a trade. So it was interesting. Okay, question about yesterday. When you have a big spike like 16 yesterday, is that low likely to be tested or not? When I see that, I'm looking at that as an expanding triangle or a wedge bull flag. So expanding triangle 1, 2, 3, 4, 5, or wedge 1, 2, 3, a pullback and a broad bull channel. So when I see that, I'm not expecting it to be tested, but I'm concerned that it did not close on its high. It's forcing you to buy above a bear bar. You have consecutive bear bars, and then you have a bear IOI. So I would not expect the 16 low to be tested, although it was. And had I been here, I probably would have bought, like today, I probably would have bought below 24. I might have bought above 22. And then if you look at the pullbacks, they're all small. I would have held for maybe a measured move up. I don't know if we got a measured move up. You have a double bottom neckline, and it got to around a measured move up. So if I think it's a wedge bull flag, there's no need for it to test back down after the reversal up because it's a bull flag and the bull trend is resuming. Here we had a bad buy signal bar and weak follow through, and the bulls decided that they wanted to test that 16 low one more time, and before they were willing to hold, which they did over here. So in a bull trend, if I see a pullback and it's a high 2 or a wedge, I don't assume that the low has to be tested. If there's enough selling pressure in the sell-off, and if the bear channel is tight enough, even if it's a bull flag, usually you get tested. And I'm not convinced that this was bearish enough to get tested, but it did. It went one tick below and then reversed up a second time. Okay, where are the inflection points for always in today? Where did it switch back and forth? I think I said on bar 4 that I thought it was probably always in short, that we were reversing down from yesterday's high, but I thought the downside was not great. So if I were trading always in, I would have sold the 4 close and I would have gotten out above 8, and then I would have bought again either above 13 or on the 15 close, and I would have gotten out after a micro double top below 18 or below 20, and I probably would have bought again either above 32 or above 38. Had I bought above 32, I would have gotten out below 35. It looks like we're in a triangle. We have a bear bar, so it looks like we're going a little bit lower. So the bears sell here. Bulls, they might buy here, or they might wait for the 40 low or the 42 close, always in long. I would get out below 60. As far as shorting goes, I think we'll get a couple legs down to 47, but I'm not sure that we'll convert to short. And then if a trader did not get out, or if a trader did not sell, selling below 70 is probably okay, but we're probably going to double bottom around the 47 low, which we did. And then it's back to always in long, 74 close or 75 close. What do you think about the bonds on the weekly chart? Yeah, bonds I think are really fascinating. I've written about it. I'm trying to reduce this down. I've written about it a few times over the past year, but my opinion has not changed. Okay. Daily chart, we're in a broad bull channel. Weekly chart, we're getting to the top of the sell climax. But, monthly chart, we have a nested wedge top on the monthly chart. We have a small wedge, 1, 2, 3, a bigger wedge, 1, 2, 3, and a bigger wedge, 1, 2, 3. I think that there's a 60 or 70% chance that we've seen the high of the next 20 or 30 years. And therefore, I think this is a bull, a bear rally. In other words, I think we've already seen the top. And if we do get above this high, I think there'll be sellers above. Bears made money starting selling above here, above here, above here, above here, above here, above here. What happens if we get above here? Bears are going to sell. I think more likely this sell-off was so strong, we'll get a second leg down. 1, pullback 2. No, probably 1, pullback 2. And we're probably in the process of trending down on the bottom chart for 20 years. That means I think the interest rates are going up for the next 20 years. What will change my mind? Nothing, because I think even if we get above the wedge top, whenever you break above a wedge top, in general, 50-50 chance you're going up for a measured move, 50-50 chance the breakout will fail. And then you adjust the percentages based on context. Based on this context, if we break to above this high, I think 60% chance the breakout will fail, and that will reverse down. So right now, I think interest rates are going up for the next 20 years. And that means I think bonds are going down for the next 20 years. Okay, Al, I find the 5-minute chart boring. Do your always in buyers, always in buyers below 20 moving average concepts apply to the 1-minute chart and the 30-second chart? Yes, they do. All right. They apply to any time frame, and they even apply to a tick chart. But unless you're a computer or running an algorithm, it's going to be impossible to make money on it. And I think you'll find that if you trade the 1-minute chart or the 30-second chart or 15-second chart, it's going to be really hard to make money. It's more interesting because you have to do a lot more thinking, and you have to do a lot more. You have to make a lot more decisions, and you make a lot more trades. And if you use wide stops and scale in, I do think you can make money doing it, but I think it's not worth doing it. So I know when I was your age, I don't know when I was in my 30s, 30 years ago, I couldn't understand how anyone could possibly trade a 5-minute chart. Everything just happens so slowly. It's like watching, grass grow. It just happens so slowly. And over the years, what I discovered is that there's an incredible amount of stuff happening on the 5-minute chart. So even though there may not be clear, easy signals every few seconds, there's an incredible amount of information on the 5-minute chart. And therefore, I no longer find it boring. I see all kinds of stuff. And for me, it's entertaining, and I see trades all day long, pretty much in every bar. So, I honestly think you will not make money trading on the 1-minute chart or the 30-second chart. And I think it's better if you instead start looking for all the little relationships that take place on the 5-minute chart and try to develop patience. I say that, but when I was your age, it was impossible. When I was 35 years old, 40 years old, there was just no way I could, it's not like I could take a patience pill or flip a switch and suddenly become patient. I just could not do it. And therefore I ended up trading a lot on 1-minute chart, 2-minute chart, 3-minute chart. And, you get a lot more trades, but I'm not sure that you make any more money. If you're really, really good, you might be able to do it, but I do not think it's sustainable. I think that as you trade more and more and you see more and more stuff and you start doing the math, comparing what you could make on the 5-minute chart versus the 30-second chart or the 1-minute chart, you'll conclude that you'll make at least as much money on the 5-minute chart, and it'll be less stressful and more fun. Okay, back to the question. I'm concerned that I cannot trust price action concepts on lower time frames because 3 trend bars on the 1-minute chart for always in is not even a full bar on the 5-minute. I think you trade 1 time frame. You don't worry about 2 time frames. And let me say one other thing about the 1-minute chart. A lot of times when you get reversals, you'll see them happening on the 1-minute chart. Once you start to see bull bars closing on their highs, the market sells off. This is the 1-minute chart today. Bull bars closing on the highs. Once you start to get 3 or 4 bull bars closing on their highs, you're probably going to get a reversal up. And once you start to get a rally and you start to get bear bars closing on their lows, you're usually going to get a reversal down. So we're going up. We're starting to get bear bars closing on their lows. We're probably going to go down. We went down. We're starting to get bull bars closing on their highs. We're probably going to go up at least a little bit. Back to the 5-minute chart. So I think we're going higher, but not a lot higher. And I think we'll probably pretty much stay sideways until the central banks start to make their announcements. I'm not even sure what days they're going to be there, what days they're going to do their announcements. Let me just pop up on the other computer, the reports. Trying to see, I'm pretty sure there's an FOMC meeting this month. FOMC meeting September 20th. So that might be the fireworks day in the United States, and I'm not sure of the dates in the other markets. And I would not be surprised if we rally strongly 30, 40, 50 points and then reverse, in other words, a climactic reversal. But I think the upside is probably limited, and I think we're going down to the March lows at some point in the next few months. Okay, hope everybody has a good night.